Good afternoon, ladies and gentlemen, and welcome one and all to this afternoon's Markets Now session. Hey, Scotty D, good to see you, buddy. Good afternoon, Core Team. Good afternoon, Ryan, and the rest of you in there as well. Hey, Nadia, good to see you. And for when this is uploaded later as well, good afternoon to everybody out there on the YouTube side of things. Hope you guys are doing well out there at the moment as well. It's been a pretty shaky start to our trading week this week. A lot of turbulent things going on around the world. If you're an everyday UTC trader, you will know exactly what they are. If you are not, we've had the Davos Summit taking place over the last couple of days, and it finishes tomorrow, I believe, which is the World Economic Forum. And this is basically a collection of the world's powerful and wealthy government leaders from all over the world. I think there's something like over 50 prime ministers or something that are attending it. President of the United States, the DT. And the rest of them, they're all there, all discussing the shape of the world and policy and getting really wellied. And basically deciding the fate of us all. Things don't look bright on the Greenland front. It seems to be developing escalation on a daily basis. I'm not going to go down the rabbit hole. I've even recognised it in myself that it's been a bit consuming recently, just being plugged into the news all the time and thinking about how the portfolios are going to be sort of affected and making necessary changes as and when. But from a CFD perspective, which is what we're all here for, we are considering some changes as well, at least from an advisory place, because there's been a lot of shakeouts in the market. We've seen a reduction in breakout trading volume across a lot of the assets. I think most of them, to be honest with you, it's not been great. It's not been shaping up to be too good. And you can't really blame the markets. I was saying this yesterday. You can't really blame the markets for it, because at the end of the day, what you're witnessing is it's a psychological print of how everyone is feeling at this time about the shape of the world and where they want their money. So there's a lot of indecision going on out there at the moment. In the majority of markets, we will cover, obviously, the outliers. Natural gas, insane move today. It did reach from a low to high today of 28.3%, which is just insane. I mean, it really is. We haven't seen that kind of daily growth in a long time from natural gas. Hey, good afternoon, Agency. And we got Braden in the house as well. Good to see you, buddy. Welcome back, mate. I hope you're doing well. We've also got a 2.26% day in gold at the moment. So we've seen a lot of safe haven money flee into gold. And I mean, this is the kind of theme and topics that we've been discussing on a daily basis. For those of you guys out there, you catch up with me on a Wednesday. When you can, you kind of get a snippet, a little singular window onto the insight of what we've been discussing and stuff. But I do like to try and keep you up to tabs as much as possible. So anyway, with all that being said, there is a hell of a lot going on around the world at the moment. Times are very tense. Investor sentiment is incredibly mixed at the moment. Investors don't really know where they want their money, but as we know historically, when things are very, very uncertain and we have a lot of fear in the markets, usually we see that money flow straight from the risky assets straight into the safe havens. And that is what we are witnessing right now. A huge, huge risk-off cycle where we're looking at all the money from the US indices, European indices, all buying into precious commodities, precious metals. You've got gold, silver, platinum. We've also had a demand vacuum. Geopolitical tensions have increased quite significantly in some of the natural gas production facilities have been affected by this. But not only that, we've got a mega freeze or a super freeze in the US, huge whiteouts in large areas of the United States, and some of the facilities that generate the natural gas have actually frozen. I'm not kidding there. I've got that from a good source. I've read that from a pretty reputable source, which I was amazed at, to be honest. But sort of inflated the demand for natural gas as well. So obviously we've got the terrible weather in the US, but it's also now, production is down for natural gas, which is causing this severe demand cycle that we're looking at here. Just to give you guys a little bit of a show, look at the size of that move. It's ridiculous. I mean, ultimately, we're only on Wednesday afternoon. The Friday close was at 328. On Wednesday morning, we're trading up at a high of 5.041. Now, just to put things into perspective, the long-term long that we took last year, where we had a 23x return on our investment in natural gas, real good stuff, by the way, the entire thing almost took place again. We didn't start exactly from when we started off last time, of course, but it was close. It was real close. We got down to the low there of 317. And in the space of a couple of active trading days, I mean, we rallied back for 58.74% over the course of a few days. This is not, remember, this is a 4-hour time frame, not a daily chart. So we're looking at some real extremes happening at the moment, and we haven't got anything quite that extreme going on in the US stocks currently, but we can see that a lot of these floors that we were originally discussing have been broken. So for example, the US 30 Dow floor was here. That's been smashed through. We're now trading at 48,328. This is just setting down just as we're streaming right now, actually, just as this session's going on. We've just touched down onto that sort of median of the two margins. So obviously we're going to be looking for the next break of structure down at around 48,221 and looking for the continuation down to the very bottom there at 4780. NAS 100 has got a confirmed break, close and retest liquidity, so now that one's paved the way for a move, I'd say down to at least 24,636, probably lower. Naturally, the US technology stocks and the indice itself would be a little bit more resilient towards geopolitical tensions and other things like that because of how, what's the right term? Sort of the global spread of it. Let's say the global spread. So you've got a lot going on in here which everybody around the world benefits from. It's not just it's the top US companies, but everybody is using them. So because of that, it usually keeps the price quite afloat unless something significant happens. We get word on the wire that God forbid this happens, but if word came out on the wire, that there was a military strike or something on Greenland, or something kicks off between the US and the other now 34 nations who have sent military personnel or ordnance to Greenland to defend, if something like that happened, then obviously you'd see the thing completely sink. But we're not there yet, and let's all hope and pray that we don't get to that stage, although it does... I know, at least from the posturing and the words that are being spoken, does seem, I can't believe I'm saying this, but it does actually seem like it is a potential outcome that we need to take seriously. We do need to take it seriously. The rest of it, let's have a look at the S&P then. And the S&P's been slapped as well. So we started out at the high, beginning of January. The high of the move was 7K, just a touch above. Now trading at 679. And still going lower as well. I mean, make no mistakes, guys. These are pretty big drops. So beginning of the year to current price, we're looking at a 3.1% shave off the top. It's nothing to shout home about in terms of being in bear market territory yet, as I did explain to everyone yesterday. But for those of you, again, who are the sort of the Wednesday group, bear market territory, we won't be seeing that for some time yet. So it's certainly too early to say we're trading bear market. But yeah, I think if we continue on this trajectory, it won't be too long before we are seriously considering the possibility that we could be looking at a 20 to 25% shave off of the top of these indices. I mean, if we look at the high up here, back down to the major inflection point, that's 13% there. At 20 to 25%, that's going to be, down sort of, let's say, that point there at 20% kind of thing, which may be seriously on the cards if things continue. Now, finally, just before we get onto the technical analysis, just one little bit more of the fundamentals here as well, is that the response from the US to all of the nations that have been defending Greenland is trades. So, of course, Donald Trump, the weapon that he's got to utilize now to try and get others to back off Greenland and let him control it is tariffs. So he's now begun slapping tariffs again on a load of different nations, opening up the scale of the trade war that was already resolved, and everything kind of got underway with that, and we were settled as much as we could be with the new trade setup. But the tariffs are now being slapped on everyone again, and that's the UK included. So obviously with that, that's going to detrimentally affect, and significantly so, the European indices and European equities markets. We will see that bleed out into the US indices as well, because of items called exchange traded funds, ETFs, which collect all of these kinds of things together and create one major trading asset around them, which is really good for large investment portfolios because it means that they can incur little risk in dangerous times. It's a very safe way to trade, unless you're as lucky as to live in Australia, which, by the way, is the only nation in the world, to my knowledge, that allows leveraged ETF trading, which, by the way, is something I would probably cut a finger off to get my hands on. Unfortunately, we're not allowed them here in the UK, and I don't know if anyone else is allowed them either. The US isn't either, but they sound like awesome assets, and I'd really like to get my hands on them. So, if anyone has any ideas on how to get me some leveraged exchange traded funds, let me know, please. Apart from that, yeah, that's about it. That's where we are. Oh, I do beg your pardon. Sorry, just to finish off about the tariffs. The US, by slapping tariffs on the rest of these nations, bearing in mind there's quite a few in the pool that the tariffs have been slapped against, it is going to rally inflation in the United States, which they are coming sort of to the last sort of hurdle now, the last major stretch before they reach their 2% inflationary target. Now, this is crucial, team, crucial, because if we start to see a rally in inflation and the sort of, the rise back of it after they've spent so damn long trying to counter it again, we're going to see a lot of economic turmoil in the United States, and that is going to have bleed out effects in everything that we touch. That is US indices, US equity markets, DXY. That's going to affect things like the Euro USD. We also may see some crazy transitional cycle of the dollar no longer being the world reserve currency. It may flip out to be the euro, So there's a lot going on right now, as you can probably tell from my a lot from the way I'm speaking about it. There's just so much to talk about. Anyway, we don't have all the time in the world, and we're already 1:45. I appreciate we need to get on with the actual technical analysis well and get that out there so that we're all ready for this afternoon. So just a little bit of housekeeping. It's been pretty mixed results this week from the UTC trading fund perspective. We've got, let me just go down here for a moment. We had a variety of potential trading opportunities. A lot of them, they didn't really work out. The GA didn't trigger. The Euro NTD it actually fell away significantly from where we were looking to jump in on that one. We got the Euro Yen, which was a beautiful trade. It would have worked out, gone straight to target profit, except for the fact that the only trigger point for this would have taken place overnight, which is obviously when we're all in bed here. So that one was a fallout as well. Couldn't get in on that one. We had the Aussie NZD, which is the only trade that ended up triggering from the opportunities that we listed. And it went straight to stop loss. I say straight to stop loss. It triggered and remained up and around here for a while, as you can see, but then ended up going down and breaking structure again, unfortunately. So I won't be going for a round 2 of that one. And the only good news is that a long-term buy and hold in Aussie CAD, and I say long-term with a pinch of salt, it was about 6 or 7 days. We finally did reach TP on this one. And yes, that was not a target profit achieved. It's ridiculous why it wasn't, but it wasn't. So we had to weather the storm whilst it came back down and came back up again. But that was a really nice one to 3.65. So not a bad turnout for that one, and I'm very happy to see that land in the basket. Moving on up, we have been looking for opportunities in gold. very consistently. We've not been turning a blind eye to what's been going on with gold here, of course, from the safe haven analysis and looking to get fresh buying opportunities. But team, it's been really difficult, really difficult. Obviously, in hindsight, it's like, oh yeah, there's loads of places we could have got in and made a shitload of money, but it's just not reality. We have to follow the rules, and we're always looking for the market to come back down to major areas of liquidity where we find that cash-rich area in the market. Obviously, to look to buy in with the commercial moves. As you can see, we haven't got any. We didn't get a single decent pullback to any major point of liquidity at all. It's just not stopped going, which is very understanding. Again, it's understanding given the climate, but as a trader, and whilst you're trying to mitigate risk, you have to be doing it in a professional manner so you're not going to get burned. It makes it incredibly difficult to trade. It really does. Do you want to be buying up at the top of the move like this? I mean, we said this yesterday. We were like, do we want to be buying? I can't remember where we were yesterday during the stream. So we were up and around this area in here. And what we were doing from that point on is looking for a retest of this area of liquidity to then buy back in. But what did it do? It just stopped instantly and just continued pushing. And make no mistake, it could do this for the next 2 months. It could do this for the next year. But we have to be waiting for those cash-rich points, which makes things really difficult when we're talking about billions, trillions of dollars at the end of the day flowing into gold at the moment due to safe haven risk-off reasons that I've listed at the beginning of the session. So very, very difficult to navigate. I think the best thing that we can do is just continue with what we've been looking for. We've listed out the points of inflection. We know that these points of liquidity exist. We can obviously see another one here. So then the next point of call would be to see a break close and a retest of this area. And then we can look to jump in for the next leg of the move. If you look at it on the daily time frame, it looks mean. I mean, really mean. Look at the size of that. So we've got these 3 massive bars, all growth in size as well. We've got the first, second, and third stages. I've done educational videos on this, by the way, of breaking down each candlestick like this and looking at the commercial interest and the volume in each of them. We can see that growth and uptick in volume as it increases with commercial interest. But it is going to get to a stage where we start to see flagging take place. It's not just going to instantly be, bang, a big candle down. It will end up being a really nice, big, healthy move that has this kind of ending to it, where we have a down day and an up day and then another bit of a down day, and then it will continue down lower to retest any major point of liquidity that's formed previously. Now on the daily time frame, the only one we have is all the way back down at 46.37, and that seems I can't help myself, it just seems a little bit too good to be true. Are we really going to be wiping out all of those gains for a normal retest? Probably not. So then we would have to look at the open and close of the previous candle. So for example, this in here is really of interest. That low and that high, that's an interesting area to me. So then I'd go back down to the 50-minute time frame. We'd look at these areas, and these areas are essentially this in here. This is what we're looking at. So then it still makes sense to me for gold to possibly come back down to around 47, maybe 47.40, which would be the top of a zone there. Let's just stop speculating here for a moment and actually draw one in. So very, very little zone just in between the joints of those 2 candlesticks. Back down there to the 50-minute time frame. That's here. That's that right there. So as I mentioned, around 47.60. Look for a price action retest down to this level here. Back to the opening, back to the low and the high of the previous candle and the current candle, and then we can look to scale in on this and get going with the move. So see, there are ways that we can navigate this, but it has to work with us. We can't just blast a trade at the top and hope for the best. That's not what we do around here. So that's the gold setup at the moment. Now, in terms of our energy markets, natural gas up at the highs here, definitely looks like it's building up for another position. As we can see here, money's filling into the market up and around the cash rich area of 5.0. It is worth mentioning that we are not just instantly still going to be long because of the situations that are happening behind the scenes. The technicals need to complement the fundamental situation, and vice versa. So the sweet spot is finding a technical fundamental mix that works in harmony, not that are working against each other. Because when you find two things that are working against each other, usually it's going to clash. Like two batteries that are, got the wrong ends to each other and you can't press them together. So in this kind of situation at the moment with natural gas, we're still looking at the geopolitical and fundamental reasons as to why it should be long. So what we need to be doing now, considering we're trading underneath a major point of liquidity here, make no mistake, it's a big one, is we need to be thinking about fundamental reasons why we could be selling into it. And that's going to come in the form and shape of weather reports, looking at revised forecasts for the US weather to see if things are going to warm up, and if these major whiteouts and storms are actually going to reduce. And we also need to keep our eyes on the situation in Venezuela and Iran, between the US as well and those two nations, because that is also going to have some kind of impact with the natural gas production and natural gas usage that we've got going on here at the moment, which is in control of the supply and demand inside this chart. So with NG currently, of course, looking absolutely fantastic. I've got a short bias from a technical perspective. The bias from the fundamental geopolitical perspective is considerably still long. So now is going to be the time for me to get behind the scenes, do the research, do the math, and make sure that the opportunity is going to be good, be worth it. Next up, well, I suppose we can check out oil quickly, and then we'll get onto the US indices. We're at 152 now. So UK Brent at the moment, US crude, both looking very similar as they usually do. There's not much to honestly discuss here at this time. Demand is not there for these black commodities currently. They are, they're pretty much stationary. Again, there is particular conflicts in the world that would increase the demand or increase the supply. Could go either way. But there's no news happening around them at the moment. The situation's very quiet. And when the situation's quiet, you have the main driving force of the commodity, which is going to be very quiet. It's just a complete reflection of what's going on. So we need to wait for something to happen before we can get excited about jumping in here. In terms of intraday trading opportunities, things that aren't really too relevant to fundamental elements, let's say components, there's not actually too much to consider there either. We've got a pretty dead looking range at the moment. It's not doing anything. We did form a higher high and a higher low here, which might be of some use soon, but it's way too early on in its development, and it's not mature enough to take seriously. We could potentially look at a breakout via the breaker structure point here, which would be a trade back to the previous highs. And I'm really clutching here, guys. I don't want you to think I'm not. We are clutching at opportunities here to that area. And then what we'd be looking for here is the price to travel. Looking for the price to travel down into liquidity, gather up some orders down here, reverse, and come back up to the high. It's at that area there at 64.50 where you'd be considering taking the long. But again, I'm clutching. I really am. Trading opportunities at the moment, they're all going to carry some pretty significant level of risk. There is a reason why we don't have much daily percent change going on across the board. And there is a reason why the major movers are the major movers. And we need to take that seriously. Pay the market the necessary respect, which, by the way, was the last video I released on YouTube last night. So if you haven't seen that already, please feel free to go and do so. So that's that. Yeah, that's that. I think we've covered all the bases here. So let's get ready for our US indices this afternoon, then see what we've got going on. Yesterday was a complete wipeout. Didn't trade anything in the Dow Jones. The NAS 100 wasn't even looked at. Didn't like that one at all, to be honest. And I've got to say, I don't feel too dissimilar today. The S&P 500, I took a stab at this one and took a loss. Yesterday, that was via the breaker structure there, and it came straight the way back down to stop out. And then eventually, at about 5 or 6 o'clock, ended up having a little bit of a run and a bounce. So none of these markets are looking that pretty at the moment in terms of available trading opportunity. None of them. But there are things that we can do. So for example, this area in here, it was initially looking nice. I must admit the current bar has actually pushed its way up and above liquidity, which is slightly annoying, because I was going to suggest that we could look at the potential for a long in the S&P to around there, but it's now already kind of triggered. Yeah, so that's a little bit annoying. Nevertheless, we've got further opportunity. For example, if we get a break in structure above this area in here, which is a pretty significant jump away from where we are at the moment, we could look at a 1 to 2.8, roughly. A little bit lower on the stop there. Yeah, around a 1 to 2.6, in fact. I'd be happy with that one. The other option, of course, is the market pushes... Oh, come on. The market pushes up from where it is at the moment into this pocket. Once we come into the pocket, if we reject this area, come back down, we can utilize this as the break of structure and then take a short back down to the lows. So it would look something along the lines of this. And that's yielding around a 1 to 2.5, maybe a little bit less. So something like that with the S&P this afternoon is the best of what we've got. We'll have to make it do. In terms of the NAS 100 this afternoon, again, team, I'm really not liking this one. Yeah, I don't like anything about it at the moment. The only thing that we do have, running towards our benefit, so to speak, is the fact that we're trading below the floor, which means that we should have a relatively clear path of least resistance down to, yeah, say for example this level in here, which is a nice level. That's certainly a nice block in there. Nice change of hands that we've got going on. V reversal point, big move back up. So there's commercial interest at 24.70, and I think if we can get a breakout below the low, which is going to be this area in here, then we can look at a potential short back down to this area in there. So something along the lines of that, maybe around a 1 to 2.81, dependent on spread, of course. Expensive trade. So that's not too bad. And then third and finally, the US 30 Dow Jones. I mean, look, we're gonna be looking at what we did yesterday. What we've got to hope is for the market to actually have a reaction today and not just drag its heels, because it has happened quite frequently recently, hasn't it? Now, the ideal point for entry, we're basically trading right at now. We've come back down, we've hit liquidity. I think I would like to see a little bit more of a commitment from the Dow here. More of a push into the money pit before we get the buyback. This area here is clearly a TRF. It's something that we're just going to have to deal with. This area here is the true inflection point. When you get these shallow moves like this, so you get a real nice one, and then the market comes down, but it sort of comes back almost instantly as soon as this area is hit. This is the time where you get a real shallow bounce like this, and you always prioritize the deeper of the two. So you've got two almost different market cycles here. We've got the retest of major point of liquidity. This is where the money's been captured. This area in here is more psychological warfare on retail traders. And this is where you'll get a lot of people going long and short all over the place, trying to guess which direction the market's going to go before getting fed up and either getting out for a small loss or getting out for nothing. So that's kind of the cycle that's been happening here. Also, don't forget that this area in here is the close of the US trading session, the open of the Asia session, and then the overnight Asia, which is very, very quiet historically for US markets before we start to pick up speed again in the European hours from 9 a.m. Back down to the low. So don't worry about this in a nutshell, in a very long-winded nutshell, I suppose. Don't worry about this. Worry about this. Okay, this is where we're going to. Now, let's break this down in 1 minute time frame, because it might be looking like the margins there are a bit short, but make no mistake, they will work absolutely fine and to our advantage. This is the target profit area that we're trying to seek, and the margin of availability in there, as you can see, is absolutely fine. The break of structure for this one is going to be placed about there, just off that little high, just to make sure that we're clearing away any money that's in the market still short at around this level in here. And then your opportunity is going to consist of an entry, target profit, and your stop loss, which for this trade is going to yield around a 1 to 2.3. You could get a bit more aggressive on that, but right now, team, there's just not the reason to. There's not the point. If you're going to be winning in these markets, you are seriously doing something right. The best that we can hope for is break-even situations and trying to mitigate the losses wherever possible. But there's a lot going on at the moment that we need to be able to navigate together. So a 1 to 2.3 is absolutely fine. And don't forget, the NAS 100, that's a pretty sizable trade in there. Look at the size of that one on a 1 minute chart, right? It's pretty big. This is yielding a 1 to 2.7. You could be a lot more gracious with that. You really could. I mean, that's a fantastic risk-reward ratio in this current situation. The S&P 500 trades as well. They're just the same, 1 to 2.5 and a 1 to 2.6. A couple of really nice trades in there. I would be more favoring the short rejection trade from the middle rather than the long, because at the end of the day, what you are saying by taking this long is the fact that the market, you are predicting that the market is going to have the steam to rally from where it is at the moment up to there, which is minus 0.13%, 0.83. That's going to be a 1% growth afternoon, which give me a reason why. You know, if I asked you, okay, that sounds great. What's the reason? Why would the S&P rally like that at the moment? I don't think anybody can. Nobody can. Nobody can give you a logical reason why, because there isn't one. So the long, just be careful with. Idea would be to risk accordingly. If you want to take the S&P long, you take a 0.15, you knock your risk down a bit so you're not taking so much of a hit if it backfires. You can obviously increase the risk reward ratio at full risk. So keep your risk at 0.25%, bring this down, make this a 1 to 1.65. It'll be a 1 to 1.4 or something after your spread's been taken out. I know some of you guys complain about the S&P being expensive to trade. But nevertheless, there are things that you can do. You're not trapped into just one scenario, which is the magic of risk management. Okay, so that's about it then, team. We're currently approaching 2:05. Does anybody have any questions for me or anything that they would like a little bit of further insight in or anything at all? I'm an open book, guys, so please feel free to ask. Now's your chance. I think I've already downloaded the charts for you, so I'll knock them out into the general chat area now so that everybody's got oh no, I didn't. NAS 100 and the S&P are there. That's those two. I need the US 30 Dow Jones. That's going to be that one. And the US 30 Dow. There you go. That's our three main culprits for this afternoon. All right, Braden says, nah, thanks, Max. All good. Thumbs up, thumbs up. Excellent, team. Well, listen, it's an open door policy, as always. Everybody in the room is more than welcome to ask questions or fire in ideas or charts or whatever. I am here at the end of the day. I'm on the other side of a screen, so if you need me, please feel free to reach out. If not, have a fantastic afternoon. Good luck out there in the US markets. Let's see what we can do. All right, so take care, team, and I'll catch up with you later. Cheers then. Bye-bye.